the Relative Strength Index, also known as the RSI indicator. This is one of the most popular and oldest technical analysis tools to ever be created. Even by itself, this indicator is pretty decent. Created by Wells Wilder Jr. in 1978, the RSI indicator can sometimes feel as old as time itself. But what if I told you that there is a newer indicator in town that is far better compared to the traditional RSI? Well, this indicator is called the Relative Trend Index. In this video, we're going to explore what makes this indicator better than the traditional RSI and how to use it to spot super profitable trades in the market. Let's get into it. Now, to add this new indicator to the chart, you just click on Indicators, then type in Relative Trend Index. Select this one by Zeiierman. The Relative Trend Index is an innovative technical analysis tool developed by Zeiierman that measures the strength and direction of market's trend. It's designed to adapt to market volatility and minimize the effects of minor short-term market fluctuations. The RTI is distinctive for its blend of trend following and mean reverting characteristics, as well as its super sensitivity to price action. The RTI indicator allows users to customize the trend length as well as the trend sensitivity. The trend length represents the number of data points used in the trend calculations. A longer trend length is going to reflect a more long-term trend, whereas a shorter trend length is going to capture short-term market movements. Conversely, trend sensitivity refers to the threshold for determining what constitutes a significant trend. High sensitivity levels deem fewer price movements as significant, making the indicator less sensitive to price and vice versa. Now, at this point in time, I know you may be thinking,
but how is this indicator better than the traditional RSI indicator?
Well, the Relative Trend Index presents several advantages over the Relative Strength Index. You see, while the RSI indicator solely focuses on the speed and change of price movements, leading to potential false signals during extended trending periods, the RTI indicator incorporates the relative positioning of the current closing price within its recent range, offering a broader perspective on market conditions. It's also more adaptable with user-adjustable sensitivity to fine-tune its responsiveness to market fluctuations. The RTI indicator's method of defining overbought and oversold zones is more nuanced, factoring in the prevailing trend, leading to more precise market condition assessments and potential trading opportunities. Let's take an example where the market shows a strong bullish trend. This big upward move pushes both the RSI and the RTI indicators into the overbought area. Most traders would start selling when the market hits this high level because they expect the market to start falling. But in this case, the market continues its upward move in a strong bullish trend. Now, during this strong bullish trend, we can see that the RTI indicator stays above the overbought level. But the RSI indicator drops back down under the 80 level and hovers around the 50 level, even though the market is still in a strong bullish trend. It just doesn't make any sense for the RSI indicator to be in the middle when the market is in a strong bullish trend. This is a big issue with the RSI, but the RTI indicator remains up in the overbought zone, showing us that the market is still in a strong bullish trend. This is where the RTI indicator is better than the RSI. With the RTI indicator, we could make a strategy that says every time the RTI line crosses above this yellow moving average and the crossover happens inside the overbought zone, that could be a signal to buy. Conversely, when the RTI line crosses below this yellow moving average and the crossover happens inside the oversold zone, that could be a signal to sell. And this is exactly how we're going to use this indicator to trade. But in order to have an all-rounded strategy, we're going to add 2 more indicators to the chart. But before we do that, if you're looking for a Forex broker with some of the lowest commissions and spreads in the market, then check out Handker Trade. I personally use them on a daily basis. As you can see here, this is my trading history. I mainly scalp gold. And up here, you can see that it's actually a live account. If you're like me and you love having a high leverage on your trading account, then you're in luck because Handker Trade offers a maximum leverage of 1 to 500. And if that's not enough, they're also going to give you a 100% bonus for all your deposits up to $25,000. So if you deposit, say, $500, they're going to give you a bonus of $500, so you'll have $1,000 to trade with. To access the bonus as well as all the other perks, sign up to Handker Trade using the link in the video description. Back to the video. Now let's add the two indicators I mentioned earlier. On the indicator search tab, type in market bias. Select this one by Professor X. Next, type in volume. This one by TradingView, that's under the technicals tab. Double-click on the market bias indicator to access the settings panel. Then on the inputs tab, change the smoothing to 10. Head over to the Style tab and disable the High Kanashi Smooth option, and then click OK. For the volume indicator, double-click on it, and on the Style tab, activate the volume MA, and then change its color to white. Click OK. Now, you may be asking yourself,
But how exactly will these extra indicators be of any help?
Well, for starters, the market bias indicator is going to be used for two things. First, trend confirmation to ensure that we're only trading in the direction of the overall market trend. Second, pullback confirmations, because we want to enter our trades during pullbacks to get better prices. This indicator shows a bullish trend by changing the color of this trend ribbon to bright green. For a pullback in a bullish trend, the ribbon will change color to dark green. In a bearish trend, it's the opposite. Bright red for a bearish trend and dark red for a pullback in a bearish trend. The volume indicator is going to be used for volume confirmation. I'm going to show you what that means when we take a look at some actual trades. Now, to take a long trade, these are the conditions. First, the relative trend index line, this green line right here, should cross above this yellow moving average, and this crossover needs to happen inside the overbought zone. So basically above this horizontal line at the 80 level. Having the relative trend index above the 80 level indicates that the market is in a strong bullish trend. When this green line is below this yellow moving average, that indicates a market correction or retracement, which comes to an end as soon as the green line crosses above the yellow moving average. So this crossover basically indicates a higher probability of a bullish trend continuation. The second condition is that during this crossover, the trend ribbon of the market bias indicator should be colored dark green to indicate a pullback in a bullish trend. The reason why this crossover needs to happen during a pullback is because it's going to allow us to enter our trade at a discounted price. Last but not least, during that crossover, we want the volume bar of the volume indicator to be colored green, and it should also be above this white moving average. This is to indicate the presence of enough bullish volume in the market to push the price in the direction of our trade. All our entry conditions are met on this candle, so we're going to enter a long trade here. The stop loss is going to be set below the most recent swing low. For the take profit, we're going to set it at 2 times the risk. We let the trade run and take profit. For short trades, we're just going to reverse all the conditions. So first, the relative trend index line, this green line right here, should cross below this yellow moving average, and this crossover needs to happen inside the oversold zone. So basically below this horizontal line that's at the 20 level. Having the relative trend index below the 20 level indicates that the market is in a strong bearish momentum. When this green line is above this yellow moving average, that indicates a market correction or a retracement, which comes to an end as soon as the green line crosses below the yellow moving average. So this crossover basically indicates a higher probability of a bearish trend continuation. The second condition is that during this crossover, the trend ribbon of the market bias indicator should be colored dark red to indicate a pullback in a bearish trend. The reason why this crossover needs to happen during a pullback is because it's going to allow us to enter our trade at a discounted price. Last but not least, during that crossover, we want the volume bar of the volume indicator to be colored red, and it should also be above this white moving average. This indicates the presence of enough bearish volume in the market to push the price in the direction of our trade. All our entry conditions are met on this candle, so we're going to enter a long trade here. The stop loss is going to be set above the most recent swing high. For the take profit, we're going to set it at 2 times the risk. We let the trade run and take profit. This is just one of the many strategies that you can do using the RTI indicator. On top of this, you can even try adding things like price action, smart money concepts, or even support and resistance to create a super profitable trading strategy. If you have any questions about this strategy, let us know in the comment section below. That's been it for this video. I hope you found some value. If you did, hit the like button below and consider subscribing to stay tuned. Thanks for watching. See you next time.